Hi again, it's the Catholic CEO Henry Kutarna. Welcome to the Catholic Business Wisdom Series. Today's topic, Catholic investment strategies. Is there such a thing as a Catholic investment strategy? Whether you're a business owner or you're thinking of starting a business or you're working for another employer, there is such a thing as a Catholic investment strategy. And so let's dive into that. What would be some aspects of the Catholic investment strategy? Well, first of all, ethical issues. Let's begin right there with the ethical issues. Clearly, as a Catholic, you would not invest your money for gain, to gain interest or to gain capital gains and to build a portfolio, to build wealth by investing in immoral or unethical activities. Now, that's a broad statement, I know, but the thing is, we can parse it, we can dig into it. So first of all, you would test your investments against the life issues, beginning of life, end of life, and other treatments during life. You would know what the Catholic faith teaches about that, and you would be careful. Secondly, you would test against the obvious, the virtues, the commandments, the social teaching of the Church, the magisterium, encyclicals, other papal documents, and other teachings that extend to the realm of economic and business life. Having set that aside as an important issue, and perhaps that's the one that we could spend an hour on that one alone, next you would move to your risk tolerance profile. There are business people in the Catholic world who will never be able to tolerate investing, for example, in the stock market, or become an angel investor where you invest early and you take the highest risk, or invest in Bitcoin or other such mechanisms, or invest in complicated futures trading or commodity trading, or certain areas like that that require special knowledge and inside knowledge, and where the risk is very high of making a mistake. So you would first, as the secular investment community will certainly tell you when they approach you or when you approach them, you need to understand your risk tolerance. And so I always ask that at a certain age or stage of life, for example, if you're in your teens, your risk tolerance might be higher, but at the same time, when you're in your teens and you don't really have a savings portfolio, you should be thinking carefully about prudently investing. And so you might invest only in a bank account, a simple bank savings account. Or you might buy, in the Canadian system, a Canada Savings Bond or a GIC, a Guaranteed Investment Certificate, or in the U.S. system, a CD, a Certificate of Deposit. There are complex mechanisms that are actually low risk. Many of them are guaranteed by the central banks and by the governments of the nations, and so you would examine your risk profile. At a certain other point, let's say you're married, you have children, you're working, your spouse may be working, she may be at home. Let's say you're a man who is out in the corporate world. You might be saving for your first home, the ownership of a house, and so residence for your family. And so you will want to be careful about prudently saving for that. And you wouldn't get fancy. You wouldn't put that savings dollar to save up 25 or 30% of the price of the home in high risk strategies. You would put them in a safe place, literally like a CD or a GIC or a bank account. And so one needs to analyze their risk tolerance. There's a lot of professional help available online, free, and of course any representative that visits you is going to want to sell you their thing, but the point is they also bring you knowledge of how to assess your risk profile. The next step is to calculate and think of your strategy. What is your actual strategy for investment? For example, what is the source of the money? Where are the dollars coming from? Let's say you're 15 years old. You may have a part-time job, cutting grass or doing something like that. And so you may save a portion of that. You may be 12 years old and you might be getting gifts. You might get some money or gift cards for your birthday, for Christmas, and for special occasions. And so at a certain age, you would be age sensitive in your strategy. When you're working in college, your first part-time jobs, you might save a certain percentage. You might tithe a certain percentage to charity, to your parish, and to good Catholic works, of course. But you might also then start to set aside 5%, 7%, 10%, or more of your income, gross income or net. You'd have to think about it carefully. But you would have a strategy of allocating that, taking it off the top, putting it away someplace in a safe environment. Later on, when you're earning a full salary or an income, or you're earning commissions, or you have a certain kind of a job, or even a business where you're earning return on your investment, you might be getting shareholder advances, you might be getting dividends, you might be getting interest coupons, you might be getting stock market returns. And so, depending on the level of sophistication, the strategy still is all about what's the source of the income and what percentage are you going to take away off the top, after charity, of course, and set it aside. So that's the third step, your strategy. The fourth step in a Catholic investment strategy is, I guess you could call it a kind of portfolio theory. So you could look it up. There's a lot of documentation online about portfolio theory. And in simple terms, what it means is you might have a set of buckets. Let's think of buckets or silos. And you might have one part of your investment portfolio might be to save for a home. And so you might be saving for the down payment of your house. And you might also then have a certain percentage that is invested in growth stocks in the stock market. You might have a certain other percentage, depending on your age. Let's say you're in your 60s, maybe even your 70s. You might be investing in income-producing stocks that produce dividends and give you then supplementary income to your pension or to your old age security and the other kind of mechanisms that governments offer to be age sensitive again to the needs. In the early days, you may not need income. You may be going for capital gain. In later or middle age or later days, you might be going for income to supplement your income. And so you would, as a responsible Catholic investor, check out portfolio theory. A typical action plan, could be that you might use lumps, let's say at an early age, in your teenage years perhaps, or even your early working years. You might be using money that you receive as gifts or lump sums, or from different types of employment contracts that you might get, side gigs that you might have. And so you would take those kind of monies and you would use some of them perhaps to pay your expenses. Yes, as a responsible young person, you might be living at home, but you might be paying rent or contributing to the household budget. And you might then, as a young working person, need to have your rental, your vehicle, your transportation, your entertainment, all these things covered. And so in your actions, you would create a hierarchy, I call it, of buckets and places that you would put your savings. So for example, you might, from your income, the various sources, you might save for a rainy day fund. You might say, okay, I need 6 months of income in case I lose my job or I have a medical situation that's not covered. How am I going to live? And so if you prudently decide to go for 6 months of savings, you would then begin working on that. You might also have the house purchased that we mentioned a few moments ago. In middle or later years, you'd want to have a funeral fund. A funeral costs $15,000, $20,000, $25,000 today, and so you would want to save for that. You might have medical needs in your older age that insurance or other government programs don't cover, and so you might want to save $50,000, $70,000, $100,000 even to have on hand for a medical emergency. Never mind at old age, it could happen to you at any time. You would certainly want to save for a pension. If you do not have a defined benefit pension plan at your work or a defined contribution pension plan at work, you may want to then, certainly in your business, you may not have that either if you're a business owner. So you may want to save at an early age. Start early. The compounding of interest. Everybody knows that principle, it seems. And so if you don't, you should check it out. The earlier you start, the higher the dollar value at the end when you need to draw down on these. So you would have a set of buckets. You would have an investment strategy, you could say. You would use your risk tolerance, your ethical issues test. your portfolio theory and you would take action. And so you would begin every time you earn $1, you would take a fraction of it and you would set it aside for one of these purposes in a hierarchical manner. So you would go for the first most important thing, first, second, third, fourth, and fifth. And that strategy should be renewed and reviewed annually. Once a year, at a certain time of year, you should take the time to examine the performance of your portfolio to see how it's doing and where it's heading, what direction. And of course, you would do all the tests that we talked about earlier to make sure that you're still in line with your needs as per your state of life, your age of life, and the various circumstances that you would be under. Here are a couple of other strategies that help you to improve your savings rate and therefore set aside money. One of them, for example, is if you get a promotion in your work. Let's say you get an 11 or 12% raise because you've moved up to a more senior position. The old advice has always been prudent. Don't spend to that new level. Just keep spending to your old level of living standard. Bank the raise. So if you got a 12% increase, after tax, it's going to be, I don't know, let's just say 7% for the sake of example. Well, you should bank that 7%. Don't live to it. Don't upgrade and start to live a more luxurious lifestyle. You may do that at some point prudently. I'm not saying you shouldn't exactly 100% of the time. You may be saving for that big trip to Europe for 6 weeks. You may be saving for a vehicle or for a college fund or whatever. But the thing is, you would want to be careful so that you don't, every time you get a pay increase, live up to that new standard. That's an old trick that is very prudent, because if you follow that, you can set aside a lot of money, and so when you need it later in life, you'll have it. Another rule of thumb, I know you'd know this, start early. Start, if you're a parent, teach your children at the age of 10 to save the gifts that they receive and put a certain percentage aside for charity, for the church, yes, but also for long-term savings. Open a savings account at a bank with your child. Do that as a young working person. Start early. Everyone of an adult age understands how interest rates work and the compounding value of interest rates. Start early and be consistent. Stay the course. Whatever it is you're doing, if you're going to save 5, 6, 7, 10% of your income, whether it's the gross income or the net income, stay consistent. Don't make exceptions. Don't fold easily. Stick to it. Be firm in your resolve. That's an old lesson as well, and it can pay off very visibly for you, even in middle age. Debt avoidance. It's an old trap. Credit cards, lines of credit, the ease with which we can borrow, the offers that are made every time you buy something. You buy a stove, a fridge, a car, even furniture, or even household appliances, even electronics. There's always a payment plan, an easy payment plan, only $22 a month, only $10 a month, only $50 a month. Avoid all of that. Save first. Ride the bus. If you need to buy a car, ride the bus for 6 months, save up a few dollars, and then buy the car. It's an old lesson. You've heard it before. Hardly anybody does it, but it's so important, so valuable. Avoid debt. In the short run, make sure that you are saving for your regular annual requirements: property taxes, insurance, health benefits, pension, other savings that keep you going for emergency purposes. Don't forget to, in the short term, every month that is, when you get your paycheck, or twice a month, you would be careful to set aside a fraction of the amount for your actual obligations like taxes and insurance and so on. In the long run, you would want to have a strategic plan for buying, let's say, for your equipment, for your business equipment, or for continuing liabilities like the interest on your line of credit, or to pay down the capital portion of the line of credit. In the home, you'd want to be careful to perhaps save for the time when you need a new roof. A couple of times in your lifetime, you're going to need a new roof. If you're in the same house, 20 years, 15 years, 25 years. It all depends on a lot of factors, but you're going to need a new roof. You're going to need to redecorate, repaint, remodel, add a room. add a structural, division, make more rooms, make less space, make more space, add an addition, build another garage, build a shop. All these things require a plan and savings. And so I suggest to people that they plan in what I call epochs, 3 years, 5-year epochs, EPOCH, an epoch, that the idea is that you would plan for a period of time, and you would divide your life, your future life, into several of these epochs, and you would form a major objective for savings and investment in each of those epochs. When you're saving for let's say you have young children, teenagers, for the college fund, the education fund, or for the technical training fund. Not everybody should go to university or college, as we know, but the point is you need to be saving and have savings program for the education of your children. But later than that, it might be for a home. Later than that, it might be for a pension or for health care in an older age, or special needs that you might have. So the idea of a Catholic investment strategy, as mentioned, we could be talking about this at great length, but in a few minutes here, I've summarized that prudential judgment that you show in creating your Catholic investment strategy can help you in many ways. It can reduce the risk, it can de-risk your life, it can add peace of mind, it can add a modicum of serenity to your life, and you can be careful, and you can be prudent, and you can be wise, but most of all, you can be successful in your investment strategy to achieve the goals and dreams that you have. That's the Catholic Business Wisdom series topic of the Catholic investment strategy. Thanks for being here today. We'll see you next time. It's the Catholic CEO, Henry Kutarna.